As tax time transitions from current events to recent history, it's not too early to start thinking about next year's taxes and how to make it all less painful. Robert Fragasso is back with us today. He's founder and president of Fragasso Financial Advisors, a sponsor of our region's business. And welcome. Good to see you again.
Thank you, Bill.
All right, we just got through taxes. We're all tired of it. Why should we even start focusing on it again already?
Because next year's coming up, and what you do today will impact next year's bill. No one liked the bill they had this year. So maybe we should make a resolution now that next year's bill will be as low as it should be, tax bill.
So how do you begin to get your head around this and start putting yourself in a position so that you're going to make smart decisions going forward?
Well, Bill, it's less about completing the form and more about taking the right financial planning and investment steps throughout the year. So one needs to be cognizant of many factors, but there's an interestingly unexplored fact that people don't pay attention to, and that's the top bracket in which they pay taxes. That's where all the action occurs. So for example, we pay taxes in layers, and the top bracket right now is 35%. And on average, we may pay 28 or 25 or whatever it might be, but that's not meaningful. That's an interesting number, but it's not meaningful. All the action occurs in the top bracket. If I give you $1 and it's taxable, where does it go? Top of the pile. That dollar is taxed at 35%. If conversely, we took the dollar out and sheltered it from taxation, it doesn't come out of the middle. It's not saved in your average bracket. It's saved in your highest bracket. Now that sounds kind of nerdy and non-interesting, but yet if we understand that all of the decisions we make impact or are impacted by the top bracket in which that money's paid. So if I say, let's put another $1 in our 401k plan, where are we saving it? In our top bracket.
No matter what your top bracket happens to be.
No matter what it is, 25, 35, it doesn't matter. So putting money away on a pre-tax basis in one's contributory retirement plan saves taxes in the highest bracket. So think of it this way. If you contribute $1 and your top tax bracket's 25%, if you instead took that $1 to the consumer goods store, you wouldn't take $1, you would take 75 cents because you left a quarter in the tax collector's cup. But if conversely you put it in your retirement plan, pre-tax, you put $1 away. The government now gave you an interest-free loan equal to your highest tax bracket for all those years and decades until you withdraw it.
So that means taking full advantage of your employer-sponsored retirement plan, an IRA if you don't have one of those. Take that seriously.
Absolutely. And tax deferred and tax free. Putting money away in a child's 529 plan allows it to grow tax free. You're not going to pay taxes when it comes out. So the income tax burden can marry up, or planning for that burden can marry up with good financial planning and investment management so that you're reducing your tax bill. Capital gains is another example. The government gives us a bargain basement tax rate on investments that have gone up and we've held for at least a year, and we sell them. So if you're in a 35% top tax bracket, you don't have to pay 35% on a dollar of long-term, meaning more than a year, capital gain. You pay only 15. That's quite a cut. That's a 60% cut in my tax burden. Not deferral, forgiveness forever. But yet, now think about that. I can't guarantee you a gain in your investment equal to your top tax bracket, but by being tax-wise, you can do that. So why would you pay taxes on all of those dollars simply because you were unknowing of the things that could benefit you?
Wow.
Down the road.
Really great things to think about. And so that's on our annual income piece. I mean, anything we should be thinking about in terms of really long-range tax planning, estate and inheritance, that seems to be in flux right now because of the extension of the Bush-era tax cuts.
We never know when our number is going to be called, and so therefore potentially we've got an estate tax bill tomorrow on any given day. Right now, you mentioned it, the 2-year compromise agreement has lowered the estate tax, death tax at the federal level from a high of 55% to 35%. Now I'm not suggesting you die now or next year.
No, don't do that as a tax planning strategy.
But that's also in the gift tax, there are benefits there too. So therefore one could gift money now to a charity, to a charitable trust, to children, to grandchildren. You've got to be sure that you got enough to keep you for the rest of your life. But now, instead of you can come out at a lower tax rate. I'm not recommending you do that, but this planning window of 2011 through 2012, once again marrying up financial planning principles with an understanding of the tax code, one now has choices and has flexibility to take steps that will lower the eventual tax bill.
Well, a really good point. If you're fortunate enough to have accumulated enough assets so you have a comfort level that you're going to be able to cover your expenses on through retirement, you really do have a 2-year window of opportunity here to gift to your children, your grandchildren, help them with college education. That might not come again, right?
There are multiple steps along the line that you just described where you can put a lot of money if you're able to. We always test for our clients when they're considering any major gift, and we run schedules to make sure they're going to be okay. And then with comfort and confidence, they can go ahead and make those gifts. They can benefit the charities today that they care about, as opposed to waiting, or they can set up special trusts that will do it later, but still get a tax benefit today.
All right, well, a lot to think about, and I guess you're right. No time like the present. Even though we're just done with taxes, it's never too early to start thinking about next year.
April 14th next year is too late to do anything. Today is the right time to do something about next April 15th.
All right, Bob Fragasso from Fragasso Financial Advisors. Thanks so much. Appreciate it.
Thank you for inviting me on.
Good to see you. Up next, leveraging our region's conventional wisdom. See how Visit Pittsburgh is applying its skills to attract convention goers and their dollars to our region. We'll be right back.